Okay, let's just jump right in. Think about this. Some of the absolute wealthiest people in finance, managing billions, get paid in a way that lets a huge chunk of their earnings get taxed, well, significantly less than, say, a doctor or an engineer making a good salary.
Right. We're talking about carried interest. It's basically how many private equity and venture capital managers make the really big money.
Exactly. And it's super controversial, constantly being called a loophole. So the big question is, what is carried interest, really? And why is it always, such a political football?
That's the core of it, yeah. It's tied to how well the investments do, a performance thing, but the way it's taxed just keeps fueling this debate.
So for this deep dive, we've pulled together quite a bit of material. We've got explainers on the basics, how the whole fund structure and fees work, analyses of the political arguments back and forth, and even some real compensation data.
Yeah, compensation data, which shows the scale we're talking about. Our goal today is really to unpack all of this for you. We'll define carry, walk through the mechanics, how it's actually earned.
And the tax rules. We definitely need to get into the specifics of the tax part and why it causes so much friction.
Absolutely. We'll look at the arguments for keeping it as is, the arguments for changing it, and tie it all back to those compensation numbers. By the end, you should have a much clearer picture of this, pretty critical piece of the investment world.
Okay, let's start with the absolute basics then. What is carried interest?
So think of carry as basically a performance fee. It's the share of the profits from an investment fund that goes to the manager, the firm actually running the fund. You see it mostly in alternative investments, private equity, venture capital, some hedge funds too.
So it's their reward for making the fund profitable.
Exactly. It's meant to align their interests with the investors. If the fund makes money, they make money.
Okay. And how does this fit into the typical fund structure? You hear about GPs and LPs.
Right. So these funds are usually set up as partnerships. You've got the limited partners, the LPs. These are the investors putting in most of the money. Think big institutions, pension funds, university endowments, sovereign wealth funds, sometimes very wealthy individuals.
They provide the capital.
They provide the capital, yeah. And generally, they have limited liability and aren't involved in the day-to-day running of the fund.
And the other side.
That's the general partner, the GP. That's the investment firm, the manager. They're the ones finding the deals, doing the research, managing the companies they invest in, and eventually selling them to hopefully make a profit.
Got it.
And the carried interest, that's the share of the profits that goes to the GP specifically for doing that management work. Now, GPs usually put some of their own money into, but the carry is primarily compensation for their management expertise, not just a return on their own investment.
Okay, so LPs bring the cash, GP does the management work, and this whole setup is famously tied to that 2 and 20 model, right?
That's the classic way to describe it, yeah. Two parts to how the GP firm gets paid.
Let's start with the 2.
The 2 is the management fee. It's an annual fee, usually a percentage of the fund's assets under management, or AUM. Historically, it was 2%.
Yeah.
But our sources say now maybe it's often a bit lower, like 1.5%, maybe 1.7%. And sometimes, especially in PE, it's calculated on the capital that's actually invested, not the total amount committed to the fund, especially later in the fund's life.
And what does that management fee cover?
That's the operational budget for the GP firm. It pays for salaries, the cash bonuses for the investment team, office rent, research, travel, all the costs of running the business.
So that management fee, that 1.5% or 2% gets paid every year, whether the fund makes money or loses money.
Pretty much, yeah. It keeps the lights on for the GP. Now, the 20, that's the carried interest. That's the GP's share of the actual profits the fund generates from its investments. The standard number you hear is 20%.
20% of the profits.
Right. So after certain conditions are met, and we'll get into those, the GP gets 20% of the total profits. And that pot of money is then typically split among the senior people at the firm.
Okay, so management fee for operations, carry, is the big potential upside tied to performance. You said after certain conditions are met, it's not just 20% of the very first dollar of profit generated.
Oh, definitely not. No, it's more structured than that. This is where things like the hurdle rate or preferred return come in.
A hurdle rate, like a minimum return they have to hit first.
Exactly. It's a minimum annual rate of return that the investors, the LPs, have to get back on their money before the GP gets any carried interest at all. Sources usually put this somewhere between 7% and 9% per year.
So the LPs get their initial investment back plus this minimum preferred return before the manager starts taking their 20% cut.
That's the idea, yes. And the way the money actually gets distributed follows a specific sequence, often called the distribution waterfall.
A waterfall. Okay, sounds descriptive. How does it usually work? How does the cash flow?
Think of it coming down in stages or tiers. First stage,
Right.
1, return of capital. All the money coming back from selling investments goes first to the LPs until they've gotten back every dollar they initially put in. If the GP put in their own capital, they usually get that back here too, proportionally.
Right, get the principal back first. Makes sense.
2, preferred return. After the LPs get their capital back, the next distributions go to them until they've hit that agreed upon hurdle rate, let's say 8% per year, on the capital they invested. So principal back plus that minimum profit.
Okay, capital back, then the preferred return for the investors. What's next?
3, the catch-up. Now, this is where the GP starts to get their carry, but it's often structured in a way that lets them catch up quickly. Once the LPs have cleared their hurdle, the next slice of profits often goes heavily, sometimes even 100%, to the GP.
Wait, 100%?
Yeah, or maybe 80%, but a very high percentage for a period. This continues until the GP's total share of the profits above the hurdle reaches that 20% target of all the profits above the hurdle, including what they just received in this catch-up phase. It's a mechanism to get them to their overall 20% share faster once the LP's basic return is met.
Huh. Okay, so LPs get theirs first, capital plus preferred return. Then the GP gets a bigger slice for a while to catch up to their 20% of the total profit above that hurdle.
That's basically it. It ensures that if the fund is successful enough, the GP ultimately receives 20% of all profits above that initial hurdle rate promised to the LPs.
Okay, that makes more sense now. Capital back, LP preferred return, GP catch up, and then?
The final split. Once that catch-up is done and the GP is effectively receiving 20% of the profits above the hurdle, any further profits generated are just split according to the main agreement. Typically, that's 80% to the LPs and 20% to the GP. That split continues for the rest of the fund's life.
Got it. So that waterfall structure really dictates who gets paid what and when, depending on how well the fund performs. But you mentioned earlier that not every single fund uses this exact hurdle and catch-up structure.
That's true. While it's very common in PE and VC, some other types of funds might have simpler models, maybe just a percentage of profits over a high watermark, for example, especially some hedge funds. The exact waterfall is always spelled out in detail in the fund's legal documents, the limited partnership agreement, which the LPs agree to.
Now, what about downsides? Let's say a fund starts strong, pays out carry to the GP based on early wins, but then later investments tank, and the fund overall doesn't actually make enough profit to justify that early carry payout. Can the investors get that back?
Yes, absolutely. That's what clawback provisions are designed for. Most reputable fund agreements have them. If looking at the fund's entire performance over its whole life, the GP ended up getting more carry than they were entitled to based on the final results, the clawback clause allows the LPs to effectively reclaim that excess carry.
So it protects the LPs from the GP getting paid too much based on just temporary success.
Exactly. It ensures the GP's ultimate payout reflects the long-term overall success of the fund.
But what about the individual fund managers, the people working at the GP firm? When the fund gets a distribution that includes carry for the GP, do those individuals get their share right away?
Usually not, or at least not all of it. An individual's allocation of the carried interest is typically subject to vesting over several years. Remember, these funds can last 10, 12 years, or even longer.
Ah, vesting. Like stock options, right, to keep them tied to the firm.
Precisely. It works the same way. You earn the right to your full share of the carry over time, usually as long as you stay with the firm. It's meant to align the individual manager's interests with the long-term health of the fund's investments and the firm itself. It encourages them to stick around and see the investments through.
Makes sense. And the details of that vesting are shared with the LPs, too.
Oh, yes. LPs want to see how the firm incentivizes and retains its key talent. The vesting schedule is part of showing that alignment.
Okay. And one last piece on structure. You said GPs invest their own money, too.
Yes, that's a standard and really important part. It's called the GP commitment, or GP commit. They usually invest somewhere between 1% and 3% of the total fund size with their own capital.
So they have skin in the game alongside the LPs.
Exactly. Their own money is at risk, subject to the same economics as the LP's money, earning returns through the waterfall just like any other investment. This is separate from the carried interest they earn for managing the fund. It's a critical signal of alignment.
Okay, so we've got the basics. Carry is a performance fee, the GPRP structure, the classic 2 and 20, The waterfall with hurdles and catch-ups, clawbacks, vesting, and the GP's own investment. Now, the really controversial part, the taxes.
Right. This is the heart of the loophole debate. The big deal is that in the U.S., the profits distributed as carried interest can qualify for the lower long-term capital gains tax rate instead of the much higher ordinary income tax rate that applies to salaries and bonuses.
So the money they earn for managing the investments gets taxed as if they personally invested their own money in something and held it for a long time.
That's exactly the argument critics make. They say, look, this is pay for performance. It's compensation for the service of managing the fund. It should be taxed like any other service income. But the tax code has historically allowed it to be treated as capital gains.
Has that always been the case? Or were there changes?
There was a significant change with the Tax Cuts and Jobs Act, the TCJA, back in 2017. Before that, you generally only needed to hold an investment for more than 1 year to get long-term capital gains treatment. The TCJA introduced Section 161, specifically targeting carried interests, what it calls applicable partnership interests.
And what did Section 161 do? Did it get rid of the capital gains treatment?
No, it didn't eliminate it, but it made it harder to get. Section 1061 mandates that the underlying investment held by the fund must be held for more than 3 years for the carried interest portion of the gain to qualify for the lower long-term capital gains rate.
So they tripled the holding period requirement from 1 year to 3 years, specifically for carried interest.
Correct. If the fund sells an investment it held for 3 years or less, any carried interest generated from that sale is taxed at the higher ordinary income rates. If it holds for longer than 3 years, the carry can still get the preferential capital gains rate.
Okay, a 3-year hurdle now. What's the actual difference in the tax rates? How big a deal is it?
It's pretty significant, especially at high income levels. The top federal rate for long-term capital gains is 20%. Plus, there's usually a 3.8% net investment income tax on top for higher earners. So you're looking at potentially 23.8% total.
Okay, 23.8% for capital gains and ordinary income.
The top federal ordinary income tax rate is currently 37%.
Wow, okay. 37% versus potentially 23.8%. That's more than a 13 percentage point difference.
It is. Let's use that example from one of our sources. Imagine a fund manager gets $5 million in carried interest, and it's from investments held longer than 3 years. Taxed at, say, 23.8%, the federal tax is roughly $1.19 million. But if that same $5 million were taxed as ordinary income at 37%, the tax would be $1.85 million.
That's a difference of $660,000 in taxes on just that $5 million.
Exactly. So you can see why this tax treatment is so valuable and why changing it is so fiercely debated.
And that's why people call it a loophole. Because it feels like compensation for work, getting a tax break, meant for long-term investment risk.
That's precisely the argument. Critics say it's a loophole because it allows income earned from the service of managing other people's money to be taxed at lower rates typically reserved for returns on one's own capital held at risk over time. They see it as a misclassification. Fundamentally unfair that these managers pay a lower rate on potentially huge earnings than many other high-income professionals pay on their salaries.
It's not just about the rate itself, but about the principle of how different types of income should be taxed. Is it a return on capital or is it pay for work?
That's a fundamental philosophical divide, and it's what has kept this issue boiling politically for so long.
Yeah, you mentioned this has been debated for years. It wasn't just the 2017 Act.
Oh yeah, this fight goes way back. It really picked up steam in the mid-2000s when private equity and hedge funds were just booming, and the carry payouts were getting enormous. Since about 2007, there have been proposals almost every single year in Congress or in presidential budgets to change how carry is taxed.
Really? Almost every year since 2007?
Pretty much.
Yeah.
You had early bills from people like Representative Sandra Levin trying to tax it as ordinary income. The Obama administration consistently put it in their budget proposals, arguing it was a matter of fairness.
I remember it blew up during the 2012 election, too.
Definitely. Mitt Romney's candidacy really put a spotlight on it because his income disclosures showed significant amounts of carried interest. It suddenly became a kitchen table topic, or at least a major media topic.
And wasn't that around the time Warren Buffett made that comment about his tax rate being lower than his secretary's?
Exactly. Buffett's comment wasn't specifically only about carried interest, but it highlighted the broader disparity between capital gains rates and ordinary income rates. And carried interest was, and is, a prime example of that disparity benefiting very high earners.
So it became this symbol of tax unfairness.
It really did. And the attempts continued. There was a draft proposal in 2014 to tax it at 35%. Another carried interest fairness act in 2015. Hillary Clinton even talked about using Treasury regulations to change it if Congress wouldn't act back in 2016.
Just attempt after attempt, but nothing stuck until 2017.
Right. The TCJA under President Trump was the first time legislation actually made a direct statutory change with Section 1 in 61. But, like we said, it wasn't the full overhaul critics wanted. It just raised the holding period to 3 years. It didn't fundamentally change the potential for capital gains treatment.
So a tweak, not a transformation.
You could say that. Supporters might call it a reasonable step, ensuring the tax benefit only applies to truly longer-term holdings. Critics felt it barely scratched the surface of the core issue. And even since then, the IRS has issued guidance trying to clarify the rules and prevent workarounds, making compliance more complex. But the basic 3-year structure remains.
And the debate still didn't end there.
Nope. Just look at the Inflation Reduction Act negotiations in 2022. There was a provision in there to further limit the carry tax break, but it got stripped out late in the game to get the bill passed. Shows you how politically sensitive it still is.
And it's still being talked about now.
Absolutely. Our sources mentioned discussions as recent as early 2025. You had reports of President Trump discussing potentially eliminating it with Republicans, while Democrats were reintroducing bills to tax it as ordinary income and hit it with self-employment taxes.
Because it's just perpetually on the table.
Yeah.
After all this time, all these attempts, one actual change, and it's still completely uncertain what might happen next.
It really is. The amount of money involved, the tax implications, the powerful arguments on both sides, it just keeps it in the political crosshairs.
Okay, so we've covered the what, the how, the tax rules, the history, the politics. Let's try and connect this to the real world. What does this actually mean for the compensation of people working in private equity? What does the data show?
Yeah, this is where surveys like the Heidrick struggles, one we looked at for 2024, become really useful. They give us a glimpse into the actual numbers.
What did that survey say about the general climate in PE right now?
Well, it mentioned that deal activity picked up in 2024, and they expect that to continue. Interestingly, even though there might be more experienced people available due to some firms shutting down or laying off staff, what they call dislocation, hiring top talent is still super competitive.
So demand is still high for the best people.
Seems so. Especially for people good at finding new deals and those who can actually help run the portfolio companies. And compensation-wise, despite some headwinds, the survey actually found modest gains overall in 2024 base, bonus, and carry, which was maybe a bit surprising, though the gains really vary depending on the size of the fund.
Where did they see the biggest increases?
It seemed most noticeable at smaller funds if you looked at the size of their latest fund, and also across the board at mid-sized firms like $6 to $10 billion in total assets under management. Bonuses, specifically, were up for most people, which was a change from the prior year. But really huge bonuses are still mostly just for the managing partners at the very top.
And what else are people looking for besides just pay?
Growth opportunities within the firm and increasingly a good firm culture seem really important, which makes sense given how long you're tied to a fund through vesting carry.
Right. Okay, let's get to the carry numbers themselves. And we need to remember, this is an annual salary, right? This is the potential share of profit from a fund, realized over maybe 10 plus years.
Absolutely critical distinction. It's long-term potential wealth. So looking at the survey's mean or average potential carry from the current fund people were working on across all fund sizes, for senior associates, the mean was around $200,000.
Okay.
Jump up to vice president, VP, the mean carry potential was just over $1,027,000. For principals, $2.3 million. Partners managing directors, MDs, around $2.5 million. And then managing partners, the top dogs had a mean potential carry of $7,840,000.
Wow, almost $8 million mean potential carry for managing partners. That average alone shows the scale we're talking about at the senior levels.
And that's just the average. The survey also shows upper quartile and high figures that are way, way higher, easily into the tens or even hundreds of millions for the most successful people in the biggest funds. The average gives you a baseline, but the top end is astronomical.
How much does fund size affect those numbers?
Massively. Let's take a couple of examples from the survey looking at the size of the current fund. For a mid-size fund, say $750 million to $999 million AUM, The mean carry for a VP was about $1.8 million. Interestingly, the partner MD mean in that same bracket was lower, around $785K. That might just be quirks in the data for that specific slice. Maybe fewer MDs responded or carry is distributed differently there.
Okay, but compare that to a really big fund.
Right. Now look at funds with $10 billion to $19.99 billion in AUM. A principal's mean carry, $7.6 million. Partner MD mean carry, $16 million. And the managing partner mean carry in that bracket, $62 million.
$62 million, potential carry.
In one fund. Yep. It just highlights the incredible wealth generation potential when you combine that 20% carry structure with managing enormous pools of capital successfully.
And does it look similar if you look at the firm's total assets under management across all their funds?
Very similar story, yeah. For firms managing, say, $2 billion to $4 billion total, the VP mean carry was $2.5 million, principal $5.7 million, partner MD nearly $15 million, managing partner over $52 million. And if you go to the mega firms, over $40 billion total AUM. VP mean carry $5.5 million, principal $17.4 million, partner MD a staggering $67.5 million mean potential carry.
Okay, so the data absolutely confirms it. Carried interest is a massive part of compensation, especially as you get more senior and work at larger firms, and the potential payouts are astronomical, even if realized over many years.
Exactly. And seeing these numbers gives real context to the tax debate, right? It shows you exactly what's financially at stake for the people earning this income and why the question of whether it's taxed at 23.8% or 37% is such a big deal, both for them and for government tax revenue.
Okay, let's pull this all together then. We've defined carried interest as that performance fee, usually the 20 and 2 and 20. We've walked through the waterfall return of capital, preferred return, the GP catch-up, then the final split.
Right, and the protections like clawbacks, the incentives like vesting, and the alignment from the GP's own investment.
Then we hit the tax controversy, how Section 1061 now requires a 3-year hold for carry to get the lower capital gains rate, but that preferential rate still exists, leading to that big gap compared to ordinary income tax rates.
Fueling the whole loophole debate. Is it a fair incentive for risk-taking and long-term investment that benefits the economy?
Or is it an unfair tax break for already wealthy managers, basically taxing labor income at capital gains rates?
And we saw the long history of failed attempts to change it significantly, the one actual tweak in 2017, and the fact it's still being debated.
Finally, we looked at the compensation data showing that, yes, this translates into potentially massive multi-million-dollar payouts, especially at the top.
It really sits right at that nexus of high finance, tax policy, and, frankly, political debate about fairness and wealth.
And that's why it matters, even if you're not in finance yourself. This whole carried interest discussion touches on fundamental questions about how our tax system works, who pays what, and how we treat income from work versus income from capital. It impacts tax revenue, potentially affects the returns of pension funds that invest in PE and VC.
Yeah, understanding carry gives you a window into a really significant part of the modern financial economy and the ongoing arguments about how it should be structured and taxed.
So given this incredibly long history, this persistent debate, the one change that didn't really satisfy the critics, where does it go from here? Will we finally see a major overhaul of carried interest taxation after all these years? Or will the current structure more or less continue to endure? And maybe more importantly, whatever happens with the tax rules, what are the broader economic consequences intended or unintended for investment, for risk-taking, for the companies these funds invest in? It's a question with no easy answer, but definitely something to keep an eye on.